Every client needs to have a plan that they understand, and they need to understand how that plan for care is going to be paid for, and then consider, should long-term care insurance be a part of that? And every client conversation, and it should be uniquely tailored to each client.
All right, welcome to CBS Spotlight. If you were here by mistake, you were in the right place now. I am Michael Kohrmann.
And I'm Eric Alvarado.
And we are here today with the one and only Bill Comfort himself, owner of Comfort Long-Term Care and director of training for the CLTC designation. So in case you've missed it, this is part 3 of our LTC series with Bill. And today we are going to talk about the LTC options and what exactly is out there.
So, Bill, what are the options out there? I mean, what do the policies that are available for clients do these days?
Yeah, it's a good question. I think it's really important for advisors and consumers to understand that if you're buying long-term care insurance today, you are buying products that are based on 30 years of experience, learning, pricing that is more conservative and more actual claims experience based than ever before. And pretty much every long-term care insurance policy in whatever form, and we'll talk some more about this, traditional policies versus the hybrid or combo policies, all of them today are comprehensive, which means they cover the full continuum of care. Home care, which is where most care starts, and which is where most people, if they need care, and if possible, as long as possible, they want to stay in their own home. And long-term care insurance covers that. Really, all policies cover that. Some policies maybe let you adjust the home care benefit amount compared to the amount of coverage, say, in a facility. But all policies cover home care. And again, that's important. And then adult daycare, which is a service that can help people stay at home, assisted living, dedicated memory care, residential care settings, and also what we would think of as a traditional nursing home. All of those things are covered. And I think we mentioned this in one of our previous segments. Just to put a fine point on it, this is not just nursing home insurance. In fact, people who buy long-term care insurance are buying it to give them the extra funds to stay out of a nursing home. So I think, Eric, right off the bat, that reminder that it covers home care and the continuum that people would move through, probably the most important sort of broad element to start with here.
Real quick, in reading between the lines there, am I catching this right? That carriers want you to stay in your home because it's actually cheaper than the nursing home, and the majority of clients and people want to stay in their home anyway. So this idea of everyone wanting to get shoved into a nursing home just couldn't be farther from the truth. Am I getting that right?
Yeah, I think to a degree, and in terms of benefits, the level of benefits that people might be buying from long-term care insurance, most people would certainly use all of the benefits if they were, especially in a nursing home. But I think the carriers have priced these products now, the premiums that are paid. They've priced them to recognize that care is going to start at home. It's interesting, 24/7 home care, round-the-clock professional home care, 24/7, is actually more expensive than being in a private pay, private room in a nursing home. Take $35 an hour times 24 hours times 365 days a year. We're over $200,000 for 24/7 home care. What people really need to plan for and what's available from premium budgeting, for example, is to be able to have insurance take the pressure off. So 4, 5, 6,000 a month of benefits at home that might pay 30 to 40 hours a week of home care. Some additional home care hours might come out of their cash flow, their monthly budget, some, kind of co-funding, co-payment of the costs. But the ability to take that pressure off and stay at home better and longer is really what most clients are looking for. And again, every policy today, whether it's traditional or the hybrids, are going to provide for that.
Awesome. Thank you very much for that, Bill. So question then, why might someone pick a traditional LTC or long-term care policy over a linked benefit or a hybrid long-term care policy?
Yeah, it's a really good question. And let me start by saying one type or the other, sort of the traditional standalone, we might call it pure long-term care insurance versus a hybrid or combo policy. One type versus the other is not inherently better nor worse. Either way, they're different ways to fund the insurance. There's different features and things. So traditional long-term care insurance, I just called it pure long-term care insurance. You pay a premium every month or every year for a chosen prescribed set of benefits, benefit amount and benefit period and inflation increases, for example. You pay a premium every year, either until you need care or you die. And what you're doing with a traditional policy is you're paying the lowest possible premium for the highest possible benefit if the risk happens, if the long-term care event, the need for care occurs. Now, the sort of common objection or obvious issue is, well, what if I pay in for 20 or 30 years and I never need care? Well, that was the insurance deal. And it's sort of flip, but I like to point out none of us lay awake in bed at night wishing for a big kitchen fire because our homeowners company's been ripping us off for 20 years, right? We hope we don't have the risk. And because we hope we don't have the risk, let's keep our premium outlay as small as possible to buy the coverage. Now, the hybrid or combo policies, sort of the first blush advantage is if you never need care, you or your family gets a death benefit. Or if it's an annuity combo, they get all the cash value back from that. But, and it's essentially a return of premium. If
I was
you think
just about to
and,
ask that, yeah.
And it's kind of how they're designed. You asked before, how do the insurance companies design the policies to encourage home care or whatever? On the hybrid policies, especially the ones that are purpose-built for funding for care, and where there's a base, say, life insurance policy, and then what we call an extension or continuation of benefits. So you use up your life insurance first, but that's not all. Life insurance might pay for care for 2 years, for example, and then there's another 4 years of coverage for long-term care. But if you never need care, there's that death benefit. And it's usually designed to essentially return the premium you paid to you. That's attractive to some people, but you pay more premium for the right to get money back or for your estate to get money back if you never need care. So you have to be really careful in comparing the products and the types of policies to not just get hung up on a sort of an emotional reaction to how does insurance work, right? And the phrase that's always used is traditional policies are use it or lose it, right? Well, yeah, it's use it or lose it, but you've paid a lot less premium over the years than a policy that's going to return premium to you through a death benefit or cash value. Again, nothing wrong with either way. And we were talking a little bit about what types of people use different types of products, and I think that's the more important consideration. Not which is inherently better, but really asking yourself or the advisor asking the plan for the unique individual client, what's best for this person, this couple, this family, and their finances. That's really what should drive the decision or the recommendation.
So this goes back to part 2, where we have every client deserves that individual custom conversation to figure out how this goes for product and everything aside. This is that custom conversation first, then we can figure out where to go from there.
Right. This is a different level where there's, again, a responsibility by the advisor to check our biases, and we all have them, preferences of different types of policies or how they work, but to make sure that we're checking, sort of checking at the door what our biases are, so that we're doing what's truly best for this individual client, couple, or family, that's before us in the moment.
So, Bill, what would you say to an advisor or a client that says they are going to self-insure, or they're looking into self-insuring?
Yeah, and that's really the other option, right? The only way to pay for care is either self-funding, buying long-term care insurance, or going on Medicaid. And the presumption here is that the advisors, the clients that are listening to these conversations we're having are probably never going to go on Medicaid, right? So it's really self-insuring or long-term care insurance. And it's not a zero-sum decision. Most people who buy long-term care insurance, as I suggested a couple minutes ago, they're not really buying 100% of the highest possible, whatever cost of care. They're insuring enough to take the pressure off the cash flow, the portfolio, or just off the family's worries, right? Let's shift some of the risk. So, Eric, I think this idea that it's not a zero-sum decision, A or B, it's usually a combination. But kind of the idea, well, do we even need any insurance at all, right? We should self-insure, or I like the concept of self-funding better.
Right.
Self-insuring implies that you're pushing that risk onto someone else.
Yeah, insurance applies pooling of risk. And if you're taking the risk on 100% yourself, there's no insuring going on. But we're kind of picking at the semantics there. So one of the things that I like to point out when people say, well, do you think we have enough to self-fund or self-insure? I like to point out, I don't mean to be, again, sort of flip or short about it, but that's not a choice you make in the future. Self-funding is the default plan that everybody has in force already today. So I think what financial advisors need to do, if they or their clients want to consider what about self-funding, you have to play it out. You have to run the numbers. You have to run the projection. Not just could it work? Yeah. And again, there's a lot of variables that can go into that. When does it start? How long does it last? What are the investment assumptions under a self-funding pool of money? It's the default plan, and the question is then, are you comfortable with this? Or would you like to insure at least some of the risk? And I think that approach helps clients feel like, all right, I'm not paying unlimited premiums for unlimited insurance. I'm paying something to take maybe the biggest chunk of the risk away, or enough of it that the rest of our plan can continue to work the way that we want it to. And I think approaching it from that standpoint is the best approach. And again, it's individualized. We could have two couples with the exact same net worth, exact same amount of money under management, but with very different lifestyles, very different priorities, very different estate planning agendas, who might end up with very different recommendations regarding whether they should self-fund or buy at least some insurance.
So if I can summarize all of that, then it's not a question of covering all if an LTC event happens. It's really questioning is how much, and do we want to put a safeguard in there to prevent the portfolio from imploding on itself if there's suddenly a request for $10,000 a month in care, which is a very reasonable number to say, which is kind of alarming. Right. But that makes complete sense. It's not an all or nothing. It's not zero sum. I really wasn't sure what you were going for when you said that earlier. Now that makes a lot more sense.
Yeah. And the other thing with self-funding, and this is kind of a reframing of the idea. You don't self-fund from assets. You self-fund from income, from cash flow, especially for couples. See, when the first spouse needs care and they're both alive, you can't spend down assets because the assets are producing the income, which is supporting the lifestyle, which continues even if one needs care, and you must preserve the assets and the income for the spouse that's going to survive. How long will he or she live? So the question about self-funding should never be how much do you have in assets or measure it that way. It's what's the cash flow, the lifestyle expenses. And the question I ask is 40 hours a week of part-time home care is $6,000 a month. And the question is, if especially for couples, if one of the two of you needed care, where would you get an extra $6,000 a month of cash flow? And that kind of changes the analysis or how we run the numbers out for folks, and it makes it a little more direct in that retirement planning and budgeting, as opposed to just sort of, well, we could assign X asset or Y asset, which is somewhat abstract.
Well, can you map out the LTC, the flow of an LTC conversation for us, Bill? I think that'd be really helpful.
Yeah, absolutely. So, we've talked about sort of touched on in a couple of the sessions that we've done already in this series that you can start the conversation as simply as by saying, we need to talk about something we haven't really directly addressed previously, and that's planning for extended care. And the direct question to clients is, so if you needed care, if you needed help safely getting through the day, either because of physical limitations or cognitive limitations, what's your plan? Now, that's pretty simple. What is your plan for care? Clients can take it a lot of different ways. Often because they're sitting with a financial planner, they jump straight to numbers in their heads. But I think it's good to open with a general question and see where they are. But the advisor has to be able to guide and lead clients on a purposeful journey or process. And so this question of what is your plan for care? It's not first about how will you pay for care, what would it cost? Asking what is your plan for care starts with what kind of care would you want for yourself or your spouse or partner? Where will it be provided? Who would provide it? What might some of the variables be? And only then should you go to cost. And that's really hard for a lot of financial advisors because we are financial people. We're comfortable with numbers. We're comfortable with money. We're comfortable with financial solutions like savings accounts and investments and insurance products.
We like things black and white.
But that's really the last step of the process.
So what's your plan, how you're going to fund it, that approach? What are some key points that we can touch on in that, though, after that conversation's been had?
Right. So it's interesting. You have to address the risk. And the question on the table is, will it happen? Is it reasonable to consider that it will happen to me? And it's not a statistical engagement. It's not scary stats. It's not trying to scare people to engage. For a lot of clients, that doesn't work. That pushes them further away. But it's interesting. If the client doesn't accept that it's a reasonable risk to plan for, and they persist in kind of what's the most common objection to the whole subject, and that is, I don't think it'll ever happen to me, or I hope it doesn't happen to me, right? So I'm just going to keep it as far away as possible.
We're all Superman in our own mind.
If you don't address if you don't address the risk, you then can't address the consequences, the personal caregiving and financial consequences. So, and it's very simple. And here's what's great for advisors. The question is, listen, we have to focus on this because the risk is significant and the risk of needing care is magnified in the same way, the same concerns that we have when we look at longevity of your retirement plan and its need to match your personal longevity. And here's the real simple question that I ask that puts a pin in this risk idea. If it's reasonable, whatever the client's numbers are, whatever is used in the software to do the retirement income and financial security projections or the Monte Carlo analysis, so whatever the age is, but it's probably 90 or longer. And the question is, Mr. and Mrs. Jones, Bob, Mary, if it's reasonable that everything else we're doing is premised on the very reasonable assumption that you could live to 90, if not longer, isn't it also reasonable that you could need care for a few years along the way?
That sounds very reasonable. We are already financially planning to live that long in the first place.
And this is one of those questions and points that should naturally come to financial advisors who are already using that, longevity risk multiplier problem, in investment and retirement planning. It's drawing that connection there. And it's connecting with the client on a belief they already have. Now, the client might say, well, Bill, Michael, what are the odds? What are the chances? And you know what I say? For you individually, I don't know. But it's significant. I mean, right, the statistics, it's a little more than 50% that you'll need a significant amount of care. And that can be compelling. But the real issue is it reasonable to consider that it could happen? Yes. Good. Now we go to the next step, which is if you need care, what happens to your family and your finances, right? What are the consequences of personal caregiving, which a lot of people don't want to have happen? But to keep their family out, you have to bring professionals in. And there's a financial cost to that, which then now finally brings us to the third kind of step in this process, if you like, which is saying, so how will you pay for it?
That's perfect. Thank you very much, Bill. So from what I'm gathering, it is what's your plan? How are you going to fund it? And all of these policies cover home health care and the kind of benefits that clients want and care about in terms of their needs for home health care, in-home health care, out of home, to get that support, because it's If I'm gathering this correct, it's less about you, the person, and getting protected. It's more about your family and allowing them to dictate your kind of care rather than give it themselves.
Right. I like to say to the client, so, whether it's an individual or a couple, so the individual who is buying and owning long-term care insurance, the insurance helps pay for your care, but who does it protect? It protects your spouse, it protects your kids, it protects your friends if you're single from having to be caregivers or having to be significant caregivers, or as you were suggesting, to allow them to help manage and direct the care versus having to be primary caregivers. And it takes money to do that. So yeah, it pays for your care. But what moves people to action is the compelling need to continue to provide for and protect others, those they love.
Very well said, Bill.
Thanks.
Well, Bill, thank you so much for taking the time out of your day to speak with us today. I really, really appreciate it. Do you have any closing comments for the audience?
Listen, it's a privilege to get to speak to the advisors that you work with, and by extension their clients as well. I think the big picture here is every client needs to have a plan that they understand, and they need to understand how that plan for care is going to be paid for, and then consider, should long-term care insurance be a part of that? And it's truly an every client conversation, and it should be uniquely tailored to each client. So thanks for allowing me to help share that message.
Thank you very much, Bill. Could not have said it better myself. But in the end there, I am Michael Kohrmann.
And I'm Eric Alvarado.
And this has been CBS Spotlight, your friendly conversation about insurance and wealth advising come together. Thank you for tuning in, and don't forget to like and subscribe if you find this content valuable. We will see you all next time. Thanks.
Take care.